Welcome to Investing Insights. I'm your host, Ivana Hampton. Investing Insights is helping investors navigate market volatility. Morningstar strategists and authors will deliver timely insights, trends, and tips. These episodes will regularly pop into your podcast feed. High-stakes negotiations between the U.S. and the European Union could affect your portfolio. Negotiators are closing in on a preliminary trade deal. The clock is ticking down to President Trump's August 1st deadline. The EU represents more than 24 countries and many sectors whose products flow in and out of the U.S. Joining me is Michael Field. He's a European market strategist for Morningstar Holland. Welcome to Investing Insights, Michael. I should let our audience know that we're recording this episode on July 10th around 9:30 a.m. Chicago time, but you're in Amsterdam. What time is it there?
So we're pushing up on 5 p.m., Ivana. So we're coming to the end of the day. So hopefully I've got some good messages for you on the back of that.
I appreciate that, and I believe in you, and thank you for working late today. So let's jump into our conversation. President Trump pushed his tariff deadline from July to August. How are global markets reacting to this uncertainty during this tariff watch?
So it wasn't just pushing the deadline. If that had just been the case, it might have been kind of a positive reaction. That's generally a good thing, right? More time to figure things out. But it came along with a whole load of other threats for other countries and increases in tariffs and things like this. So I think the market's initial reaction was negative, and you saw markets fall as a result of that. But since they've kind of recovered, I think now that we've had a little bit of time to digest and figure out what are the real consequences of this, the market's back to kind of ignoring it.
Got it. So the EU is one of America's largest trading partners. How important is it for these two sides to strike a deal?
I think generally speaking, it's very important. Maybe to kind of give some context, it's not quite the China dependency on the US, but for certain industries and certain countries within Europe, it's got a significant importance. So I think, look, of all the geopolitical catalysts this year, this is way up there.
And what's at stake if the two sides don't strike a deal before the deadline?
So, as you said, we've only got a few weeks away now, and you would have hoped to have a bit more progress at this point, or have some kind of indications of what's progressing well or what's left on the table that needs to be discussed. But it's been relatively quiet up to now, which isn't an amazing sign. If the two sides don't come to a deal, ultimately it kind of adjusts to that worst case scenario of like high level tariffs between the two countries. Possibly even retaliation on the European part as well with more tariffs, which isn't going to be good news for exporters to the US, and indeed ultimately isn't going to be good news for the US consumer, which is going to bear the brunt of a lot of these tariffs also.
And I got a quick follow-up. Because you're in Europe, how is the story being covered there? What messages are you guys receiving there?
I think, look, politicians in Europe and the media in Europe are trying to downplay the situation to some degree as well, and try to talk up the positives that, look, a deal can be reached. It's just a matter of what concessions need to be made on what areas, etc. But ultimately, I think longer term, Europe's already thinking, okay, how do we minimize the danger and the exposure to the US? There's nothing we can do in the short term. We just have to work around it and compromise. But in the longer term, how are we going to stand on our own 2 feet and be much less dependent on other countries like the US?
Now, more than a dozen countries make up the EU. I should stress, more than 24 countries make up the EU. The bloc is seeking lower tariffs for a variety of sectors like aircraft, car parts, and spirits. Talk about that.
So it's a difficult one, as you mentioned, with so many stakeholders in play, right? Ultimately, the EU as a trading bloc has more power when they work together. And you've already seen this in some smaller countries like Slovenia had a call with Donald Trump early on and then was reprimanded later on by the EU to remind them that, look, we're stronger together, and you making a call doesn't actually help us as a group. So it's difficult to get all those diverse opinions and diverse interests together in one negotiating table and to kind of find out what we need from the US to actually help certain industries. But ultimately, look, the EU is reliant on all these countries to grow together to actually move the group as a whole. And if Germany doesn't do well, then the rest of the Europe isn't going to do well. And likewise with lots of other larger nations in Europe. So our interests are very much aligned from that perspective. And from the negotiation perspective, it seems to be very much aware of that, which is a good thing.
So what sectors do you think could be hit the hardest and which ones could be spared?
So luckily we've had some time to kind of digest and analyze this, which we didn't have back in April when these tariffs were first announced and everyone was scrambling around selling certain sectors and buying certain other sectors only to realize that actually, oh wait, there's more exposure than we thought. So I think, look, at this point, we can safely say that certain sectors like autos are heavily exposed, at least in the short term, to US tariffs. Likewise, electrical equipment, machinery, areas like this, all of which you can probably guess are, a lot of them originate from countries like Germany. So, countries like Germany, countries like Ireland, which produce a lot of pharmaceutical products, which are then exported to the US, are very much in the front line of tariffs, should they be enacted again at a high level. And then the safer sectors are leaning more towards utilities, which has had a great run in Europe, and we can talk about that. But consumer companies as well, more consumer defensive companies with more exposure to Europe than other countries like the US are kind of safer hiding places that investors have kind of seemingly found over the last couple of months.
And we sort of touched on this a few minutes ago, but the EU has presented a united front where their one country made a call and got some backlash for it. But how are some countries wanting a trade deal sooner than the other folks? And then you got some countries that are like, we can wait. Can you talk about the debate you're witnessing in Europe?
So there's certainly an element to that, right? And different attitudes in the beginning too, as to whether we should jump to the table like the UK did, for instance, or should we wait it out and see what other nations do? I think thus far that waiting approach seems to have worked quite well because it's given us a better insight into how negotiations take place and maybe what's the best strategy towards negotiating. So you saw the UK jump in quite quickly and get a deal with the US, but it's a deal that many looked upon and said, it's okay, but it's not amazing. And then you had China kind of hit back hard in the US and ultimately get a deal with the US that was much better than the deal they had in the first place. So I think the EU has learned a lot from this, and hopefully they can put that to good use in the next few weeks when we get an announcement. Hopefully it's leaning more towards a China type deal than a UK type deal in terms of some good concessions on the US front.
And trade deals typically take years to be implemented, so any announcement would be a preliminary agreement. If an investor has European companies in their portfolio, what would this framework mean for them in the long term?
So this is a very good point, that the difference in terminology between a deal and an agreement, right? An agreement is just something preliminary that you come up with, a handshake, if you will. And a deal is something that's more fought out over the longer term, hundreds of pages long and hammered out over kind of endless debate. And obviously the latter isn't something you're going to get within a few weeks of negotiation. It's more just the bare bones of a framework, which is what we're going to be looking at. I think from an investor's perspective, investors should probably be less concerned over the longer term than they should the shorter term, is the answer, really. If we look at European companies and their exposures, obviously we all got a shock on Liberation Day and kind of realized like, okay, certain industries are so really heavily exposed to the US and could be punished. Companies are smart and industries are smart. And like COVID and other situations that we had to get around, ultimately they find ways around this in the medium to longer term. So I think, and there could be a change of government in the US in the meantime too, and a complete kind of restructure of some of these agreements even before they're finalized. So longer term, less concerned. Shorter term, brace for maybe some potential shocks, but probably not to the same degree as we saw in April because we're a bit wiser now.
Thanks for summing that up. So let's shift to this year's market performance of European stocks. What's been winning, Michael?
So Europe as a whole has been winning is the answer. If I look over the last quarter or even year to date, Europe has been the real star performer in terms of global markets, ahead of the US, ahead of the global market index as an average. So that's good news for European stocks and investors as a whole. What's been working? Well, I think the Liberation Day has thrown a spanner in the works in terms of what's been working. If you'd asked me at the start of the year, I would have said, look, the macroeconomic environment is improving. Perhaps you should be leaning more towards cyclical stocks and kind of benefit from that. But really, Liberation Day threw that completely off. And you've had sectors like I mentioned, utilities have been the star performer over the last quarter. And also investors have been leaning heavily into sectors that are more structurally exposed to trends that aren't going to be disrupted. So, renewable energy trends, the move to kind of a more renewable grid in Europe, data center build outs, things like this, things that are going to carry on regardless. They've all really been the winners over the last quarter.
And which European stocks do Morningstar analysts consider undervalued and why?
So there's a few sectors still in Europe that we think are undervalued, despite that rally that I mentioned. Consumer discretionary is one of the big ones. You see investors are still a little bit fearful about getting involved in that sector. Healthcare is another one that investors are worried a little bit about. One, tariffs, but also two, maybe vaccines with RFK, running the health department in the US at the moment as well. So there's a couple of areas around that. And I think if you look into that, where do we see the stock opportunities? I think automakers, I've kind of danced around the word up to now, but it's one of those most heavily exposed to US tariffs. But we see companies like Renault, the French listed automaker, as one that's more heavily exposed to Europe than any other company. It's got 80% of its sales in Europe, so it's less concerned from that perspective. But at the same time, the valuation has still been dragged down along with the rest of the sector. So we see good opportunities there. And then in the consumer space, luxury has been something of a bad word for the last year and a half or so. Investors haven't had much interest in that sector, and share prices have fallen heavily as a result. But stocks like Kering are one of the few in the sector that we think are actually kind of ripe for a turnaround. Internally, they've been doing a lot of the right things. They've got good brands, and preliminary signs this year that luxury is slowly starting to pick up again as well. So we think there's a few examples there of good opportunities in Europe.
And before we got on, it was 3 stocks. Did I get all 3?
So we didn't. I saved one just in case you wanted it last. But okay, in the healthcare sector as well, I mentioned the negatives around the healthcare sector. But certainly there's bigger players in that industry like GSK, the UK listed kind of global pharma company that we think tick a lot of boxes, a wide moat stock, which is always important, but also in terms of their exposures and the business model that they run. They have some exposure to things like vaccines, but it's not through the roof, in case that's what investors are concerned about. But what we really like about stocks like this is essentially it's a machine. It's got such a wide product portfolio that's throwing off good cash flow every year that allows them then to reinvest at heavy rates and keep that pipeline going over time. And, we've been in this position in the past where investors are kind of doubtful around the prospects of the company, but they always seem to muddle through and, get something else in the pipeline to replace what's expiring and just keep going, which is always a good quality in a defensive name.
And that one of those you own, was it GSK?
The last one, indeed. Yeah.
All right. Michael, this has been a great conversation. Thank you for staying late at work and for your insights and time today.
Thanks for having me.
That wraps up this week's episode. Thanks for making this show part of your day. Subscribe to Morningstar's YouTube channel to see new videos about investment ideas, market trends, and analyst insights. If you're listening on Apple Podcasts, the Investing Insights team asks that you give our podcast 5 stars to help others find the work we're producing for you. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor Morningstar. Take care.